The Federal Reserve Fed recently made headlines by cutting interest rates for the first time in years. This decision marks a significant shift in monetary policy, as the central bank had maintained a steady rate policy since 2020 following a series of hikes aimed at controlling inflation. The rate cut reflects growing concerns about the U.S. economy's slowing growth and the global economic environment, which has been marked by uncertainty and trade tensions. By lowering rates, the Fed aims to stimulate borrowing, investment, and consumer spending, which can help stave off a potential downturn. In its statement, the Fed cited weaker-than-expected job growth, a softening manufacturing sector, and cooling inflation as key reasons for the rate reduction. Although inflation has remained stubbornly below the Fed's 2% target, the central bank is clearly prioritizing growth over concerns about price stability.
Firstly, thank you for watching, and don't forget to smash that like, subscribe, and notification bell for more global finance uncovered, as we continue to work hard and around the clock to always deliver and improve on our content for you. We would greatly appreciate your additional support by you clicking the like button, notification bell, and subscribe button and joining our channel's growth.
Fed Chair Jerome Powell emphasized that this move is a preemptive measure to cushion the economy from future risks, rather than a reaction to an immediate crisis. The rate cut is seen as a way to ensure that the longest economic expansion in U.S. history does not falter. The rate cut, which reduces the federal funds rate by 0.25%, is expected to have wide-reaching effects on the economy. For businesses, lower borrowing costs can encourage investment in new projects and expansions, potentially boosting job creation and productivity. Consumers, too, may benefit from lower interest rates on loans and mortgages, increasing their purchasing power. However, there are concerns that this could also inflate asset bubbles, particularly in the housing market, where lower mortgage rates could lead to an increase in demand and rising home prices. Financial markets reacted immediately to the Fed's announcement, with stock indices seeing significant volatility. Initially, there was a positive response as investors interpreted the move as supportive of economic growth. However, the rally was short-lived as concerns about the broader implications of the cut took hold. Some analysts fear that the rate cut could signal deeper concerns about the health of the global economy, particularly as it follows a pattern of other central banks easing monetary policy in response to slowing global growth. The Fed's decision also drew mixed reactions from economists and policymakers. Some believe the move is long overdue, given the clear signs of an economic slowdown in various sectors of the U.S. economy. Others argue that the Fed is acting too aggressively and should have waited for more concrete evidence of a downturn before cutting rates. Critics worrying that the central bank is running out of tools to combat a future recession, as interest rates are already at historically low levels and could limit the Fed's ability to respond to future crises. Internationally, the rate cut could have significant implications for global markets. Lower interest rates in the U.S. may lead to a weakening of the dollar, which would make American exports more competitive abroad. However, it could also exacerbate currency volatility, especially in emerging markets where many countries are already dealing with capital outflows and weakening currencies. The global economic slowdown, driven in part by trade tensions and geopolitical risks, has already prompted many central banks to lower their rates, and the Fed's move may spur further easing around the world. One of the key drivers behind the Fed's decision is the uncertainty surrounding the U.S.-China trade war. Prolonged tensions between the two largest economies in the world have dampened business confidence, slowed global trade, and hurt investment in both countries. The Fed appears to be positioning itself to mitigate the economic fallout from any further escalation in the trade conflict. While a resolution to the trade dispute remains elusive, the rate cut is seen as a way to provide some insurance against the negative effects of continued uncertainty. Despite the Fed's proactive stance, some argue that lowering interest rates may not be enough to sustain the current economic expansion. With fiscal policy largely constrained by high levels of government debt, the burden of supporting the economy falls heavily on the central bank. Critics argue that more comprehensive measures, such as infrastructure investment or tax reform, may be needed to address the underlying structural issues in the U.S. economy. There are also concerns that the rate cut could fuel financial instability if it encourages excessive risk-taking in financial markets. Looking ahead, the Fed signaled that it remains open to further rate cuts if economic conditions warrant. However, Fed Chair Powell was careful to temper expectations, noting that the central bank is not embarking on a prolonged cycle of rate cuts. Instead, the Fed will continue to monitor economic data closely and adjust its policy as necessary. This data-dependent approach suggests that the Fed is taking a cautious path forward, balancing the need to support the economy with concerns about the risks of too much easing. The Federal Reserve's decision to cut interest rates for the first time in 4 years reflects a significant shift in its outlook on the U.S. economy. While the move is intended to boost growth and shield the economy from future risks, it also highlights the challenges facing policymakers in an uncertain global environment. The effects of this rate cut will likely unfold over the coming months as businesses, consumers, and investors adjust to the new monetary landscape. The Federal Reserve's rate cut has sparked a wide-ranging debate about the future of monetary policy in the U.S. Some analysts argue that the Fed is being overly cautious, acting to prevent a slowdown that may not even materialize. While recent data has shown some signs of weakness, particularly in manufacturing and business investment, consumer spending remains robust and unemployment is near historic lows. This discrepancy has left some questioning whether the rate cut was necessary at this stage or if the Fed has prematurely reacted to fears of a recession. One concern raised by the Fed's move is the potential for policy exhaustion. With interest rates already relatively low by historical standards, there is limited room for future cuts should the economy face a more severe downturn. If the Fed exhausts its ability to cut rates, it may be forced to resort to more unconventional tools, such as quantitative easing, which was employed during the 2008 financial crisis. However, these tools come with risks, including asset bubbles and increasing inequality, as they tend to disproportionately benefit wealthier individuals who hold more financial assets. Another potential consequence of the Fed's rate cut is the impact on savings. Lower interest rates generally translate to lower yields on savings accounts and fixed-income investments like bonds. This can be problematic for retirees or those nearing retirement who rely on these types of investments for income. With yields dropping, these individuals may be forced to take on more risk in search of higher returns, potentially exposing them to greater financial volatility. The challenge for the Fed is finding a balance between stimulating the economy and protecting savers. The housing market is another area that could be significantly affected by the rate cut. Mortgage rates, which are closely tied to the federal funds rate, have already begun to fall in anticipation of the Fed's move. While this could make homeownership more affordable for some, there is also a risk that lower rates could inflate housing prices even further, exacerbating affordability issues in many parts of the country. Some economists worrying that a housing bubble could develop, similar to what occurred in the years leading up to the 2008 financial crisis. On the international stage, the Fed's rate cut adds another layer of complexity to global economic dynamics. Many other central banks, including those in Europe and Japan, have been engaging in their own easing policies to combat sluggish growth. The Fed's decision to lower rates could trigger further easing abroad, particularly in emerging markets that rely on U.S. dollar-denominated debt. A weaker dollar might ease some pressure on these economies, but it could also lead to increased volatility in currency markets, particularly if there is a sudden shift in capital flows. Politically, the Fed's decision to cut rates has drawn attention from the Trump administration, which has been vocal in its calls for lower interest rates to support growth. President Trump has repeatedly criticized the Fed for keeping rates too high, arguing that lower rates would help fuel the economy and boost stock market performance. While the Fed maintains its independence from political influence, some observers believe that political pressure may have played a role in the timing of the rate cut, adding a layer of complexity to future policy decisions. In terms of market expectations, the Fed's decision may have set a precedent for further rate cuts down the line. Many investors are already pricing in additional cuts later this year or in early 2024, depending on how the economic data evolves. If the economy shows further signs of weakness, particularly in key sectors like employment and consumer spending, the Fed may find itself compelled to cut rates again. However, if the economy stabilizes or rebounds, the central bank could adopt a more wait-and-see approach, allowing it to hold rates steady for longer. Ultimately, the Fed's interest rate cut underscores the delicate balancing act that central banks face in managing economic growth, inflation, and financial stability. By taking a preemptive step to ease monetary policy, the Fed is hoping to extend the current economic expansion and mitigate the risks of a slowdown. However, the effectiveness of this strategy will depend on a range of factors, including how businesses and consumers respond to the lower rates, the evolution of global trade tensions, and the broader trajectory of the U.S. economy in the months ahead.
Thank you for watching, and don't forget to smash that subscribe, like, and notification bell for more global finance uncovered.